Wish you all a very, very happy new year. As usual, we are back with our monthly market outlook. It gives me immense pleasure that two of our funds, Kotak Gilt Fund and Kotak Blue Chip, are celebrating their silver jubilee. Kotak Gilt Fund is India's first gilt fund and is going strong in its silver jubilee. It has almost delivered a return of about 9% since inception. The rolling return of Kotak Gilt Fund over last 1 year, 3 year, 5 year, 7 year, 10 year is comparable to probably all other products like debentures, bonds, fixed deposits. Kotak Blue Chip Fund again is celebrating its silver jubilee, a large cap fund. A 10,000 rupee SIP over its 25-year history would have generated a compounded annualized return of 16.36%. That's one of the very good number, and hopefully it will continue to do well in the days to come. Coming to global economy, if we see central banks around the world, they raised interest rates, bearing the exception of China, to deliver a break on the inflation. Inflation started easing off in most parts of the world compared to post-COVID hike. And as interest rates went up, the growth started falling below the trend. 2024 growth projections are all subdued, keeping in mind tight interest rates and also liquidity. The central banks around the world, thanks to rising yield, are having huge losses on their portfolio. Now it is expected that as growth has started slowing down, central banks around the world will be looking to cut interest rates in the days to come. As of today, a very large part of AUM, almost $8 trillion, is stuck in money market fund. Will this money start coming into equities or long duration fixed income fund? That will shape both interest rates and equity markets around the world. Emerging market today compared to S&P 500 in US is very, very attractively priced. For almost last 1 decade, US has been outperforming emerging market, and maybe we are at a stage where emerging markets will start outperforming US in the days to come. Coming to US economy, Fed raised interest rates at the fastest pace to regain credibility and control inflation. It was little bit slow in taking out liquidity in order to support growth. US economy continued to post good GDP numbers, partly driven by very large fiscal deficit. US continues to have high deficit, which partially explains why, despite rising rates, economy from a growth point of view is holding. The US debt has now crossed $34 trillion. It is highest than ever before. There are some signs of stress emerging on US economy. One, bank credit growth is slowing down. In fact, it has gone into negative territory. Job openings are slowly but steadily declining, and bankruptcies are rising. This year, US interest burden will cross defense spending and also cross probably $1 trillion. This stress of US economy is reflected into their stock market, where despite big rally in equities, 72% of S&P 500 stocks are underperforming S&P 500. This is one of the highest level of underperformance, including pre-COVID and post-COVID time. The growth in American stock market is driven by 7 super companies: Meta, which runs Facebook; Tesla, the electric vehicle maker; Nvidia, the chip maker; Amazon, the supermarket; Alphabet, parent of Google; Microsoft, and Apple. In fact, the 7 companies today have more market cap than Canada, France, China, UK, and Japan combined. What will Fed do? We believe interest rates generally goes up by escalator in small steps, but they come down by elevator quickly. Fed is likely to bring interest rates down in 2024. Coming to Indian economy, we remain oasis in the global desert. The headlines by and large has been positive about Indian economy. We are on course to become third largest economy. Along with China and US, we are contributing significantly to incremental GDP growth globally. In emerging market, Indian numbers continue to look better vis-a-vis its peer in terms of growth, exports, inflation, FX position, and so on and so forth. Domestic economic activity continues to move on the higher side. Capacity utilization is now above average. The manufacturing PMI is in the positive territory, and GST collections continue to remain above 1.5 lakh crore for some time. The FMCG volume growth has been little bit on the lower side. There, the growth rate is coming little bit on the softer side. We believe, hopefully, this festival season, the volume growth should start turn positive. If we look at consumption, there is K-shaped recovery. Air travel and premium SUVs continue to do well, whereas entry-level bikes and affordable housing continues to grow on a subdued basis. Consumer sentiment have remained subdued across the globe, but fortunately in India, it seems to be improving and is looking better poised compared to rest of the world. Rural recovery also seems to be on track, with consumer sentiment turning positive in rural India. The current account balance, which was threatening to go above 2%, is now hovering around a percentage point. very well within the manageability. Capital formation as a percentage of GDP is on the up move, though it is lower than what we had seen during the heady days of 2007, 2008. This capex is driven by government. This year, they will be spending for the first time in our history 10 lakh crore on infrastructure, amounting to about little above 3% of India's GDP. The central government's lead on infrastructure investment is supported by state capex as well as listed companies. And collectively, we should be looking at investments to GDP ratio of upwards of 24-25% between state, central, and listed companies. Importantly, productivity of investments have gone up, and India's incremental capital output ratio is slowly and steadily improving. It remains well below developed markets, but on an incremental basis, it is moving upwards. Real estate, which contributed substantial part of Indian economy, was subdued in last decade, mainly because of changes like RERA and oversupply and over leverage in real estate sector. Now it looks like that real estate sector is bottoming out and we should see better days ahead. The banking balance sheet remains in the perfect shape. Capital is increasing and NPAs are well within the comfort level. Oil prices, despite Israel-Hamas conflict, despite the Red Sea embargo, and despite production cut from Saudi, continues to hover below $80 a barrel, providing significant support to Indian economy. There are some signs of stress on Indian economy also. The first is very high PLF in the power plant. We are running our power plant at peak capacity of about 81% PLF. If power demand continues to remain this strong, we may witness power cuts in this summer. The second challenge for India will be to push reforms. Many countries are stuck in middle income gap as they fail to pursue path of reforms once they have moved from sub-emerging market to emerging market. The second challenge for us is accepting innovation and be ahead in disruptive technology like artificial intelligence, like machine learning, like 3D printing, like renewable energy. Geopolitical events will continue to impact us, whether it's Russia, Ukraine, Israel, Hamas, or China, Taiwan. How do we play this game to our benefit? Finally, state elections resulted into a lot of promises on freebies. We need to maintain our fiscal discipline. We need to ensure that good economics remain good politics. Despite all the challenges, the government social spending has remained under control except during COVID time. Hopefully, we will maintain balance between freebies and fiscal prudence. Converting all this into equity markets, well, we must accept limitation of predicting market. This is what giant institutions had tried to predict about the market at the beginning of 23, and S&P 500 surprised every one of them by delivering significant return. I have no doubt in my mind that 2024 also most predictions will go wrong as events will shape and influence outcome. In that context, Indian equity and Indian economy seems better poised after a period between 2014 to 2019, where our Nifty EPS CAGR was just around 4%, even though nominal GDP was growing at 11%. From 2020, India Inc.'s profit growth has picked up, and now it is in excess of nominal GDP CAGR. Let's hope and pray this cycle continues, which will be the main reason for markets to move higher. In the past, we have seen the market cap movement and profit movement of India Inc. moves in similar direction. In NSE 500, between FY20 to FY23, against 31% growth in profit, market cap moved almost to similar number. We believe India Inc. is on course to achieve about 1146 EPS for Nifty 50 for next year, that is FY 2025. A lot of this earnings growth will be driven by domestic sectors, which is excluding IT, metal, and companies, global companies like Tata Motor. Like in FY23 and 24, 25 and 26 also will see more profit growth from domestic earnings than global earnings. Valuation-wise, India continues to trade at reasonable valuation, especially in large cap. The historical average is 18.5. Current market is trading at about 19.6. When we come to mid cap, against historical average of 23.6, markets are at 18% premium to current valuation of 27.8. In the small cap, valuations are at a significant premium against average of 15.9. Current valuations are at 21.5. They are at 35% premium to its historical average. Clearly, small and mid caps are trading at a premium to their historical average, and large caps are trading just around its historical average. From a market cap to GDP point of view, against average market cap of about 80%, currently we are trading at 124%. It is reasonably high, and hence we'll have to moderate our return expectations in the days to come. Foreign portfolio investors have been large sellers of Indian equity, especially in post-COVID era, and now their holding is roughly at about 17.5%, marginal overweight to India's weight in MSCI. We believe foreign institutional investors will have limited appetite to sell a performing market like India. If we look at our premium over other emerging market nations, we are one of the rare economy which continues to trade above its historical average. Everyone else from Turkey to Thailand are trading below their historical average in terms of premium. Currently, we trade on MSCI emerging market at 60% premium. The historical average is little lower than that. Undoubtedly, we are priced for perfection, and we'll have to deliver like Virat Kohli or Rohit Sharma or Jasprit Bumrah, as people have built a lot of expectations on us. Undoubtedly, our risk premium has come down because of the development, because of the liquidity or depth in our market. This is the most important question which investors will have to answer. Should they invest in India, which is available at a very, very expensive valuation, 25 times trailing, but year after year, it has delivered positive return? Or should they go to a country like China, which hasn't delivered return for last 3 decades in US dollar terms? Will people go for performance or will people go for valuation? Undoubtedly, this is where flows will be coming into our market. Let's hope and pray that people develop courage to pay price of gold for golden country like India, and they do realize that a country like China might be available cheaper for the inherent risks in those countries. While on a PE basis, India does look expensive, we are at about 22 times forward basis, and the numbers vary because we take different estimates. But with 17% EPS growth, our price to earning growth ratio remains around 1.31. It is not as cheap as China, but it is also not expensive like other Western worlds. On a growth basis, we look in the middle corridor. On the P valuation basis, we look at the top corridor. Hopefully, people will look at PEG ratio along with our track record and will continue to invest in India rather than redeem out of India. In case there is selling by FPIs, there is money power available with domestic mutual funds. Our cash level is roughly about 1 lakh crore. In balance advantage fund, asset allocation fund will have roughly 53,000 crore to buy if markets become cheaper. EPFO and SBI can bring, EPFO and SIP can bring about 2,50,000 crores over a year's time frame. Domestic mutual funds will have firepower of about 4 lakh crore next year to absorb FPI selling in case that materializes. Foreign portfolio investors in the month of December, despite Christmas holidays, were very active, and they brought in almost $6 billion in India despite holidays. The small and mid cap, again, while looking expensive from a valuation point of view, is also showing much higher profit growth compared to large cap. On a PEG basis, small and mid cap does not look as expensive as the historical, as the valuation suggests. The small and mid cap put together were roughly about 16% of market cap in 2003. Today, they have become about 36% of market cap. Normally, when small and mid cap becomes a very large percentage of market cap, there is correction, and which is why we are a little bit cautious on small and mid cap space, despite profit growth in small and mid cap coming at higher level. The earnings yield of small and mid cap continues to move in an attractive zone, indicating that in future, small and mid caps return will be substantially lower than what we saw last year. There has been fair amount of flows in small and mid cap funds looking at their past performance, and undoubtedly these flows have been growing on a month on month basis, reflecting people giving more weight to past performance than future potential. The divestment has slowed down substantially despite market rising, which has allowed PSU stocks to rally for lack of supply. We believe at some point of time, government will look at divestment to fund the budget deficit. And as and when supply emerges in PSU stocks, their valuation could come under pressure. Our call on market continues to remain same as last month. Marginal overweight large cap, marginal underweight small cap, and equal weight mid cap with neutral allocation to equity. Keep some dry powder in case correction materializes. If there's no correction, then your neutral allocation to equity at this fair at this historical average valuation should continue to make money for you. One interesting data about election year, not only in India, but also across the world, election year has delivered maximum return compared to non-election years. Non-election year returns comes down in India as well as rest of the world. So who knows, this year we are seeing past getting repeated. Another interesting tidbits, every time there is a leap year, markets, Indian markets especially, have seen either correction or a subdued rate of return. Of course, every rule has exception. And in the leap year of 2012, markets did witness positive return. But bearing that, in 2000, we had TMT bubble. 2004, on the day of election, markets corrected. 2008, leap year was a global subprime crisis. 2016 was after effects of demonetization and taper tantrum, and Nifty gave lower return than fixed income. 2020, markets corrected thanks to COVID. Will we see same history getting repeated in 2024? Or will there be the earlier slide of election year giving better return than non-election year? Whether history will repeat or we will make exceptions to the rule. US Fed is expected to cut rates in 2024. And we have seen the performance of Asian market in a cycle of US interest rates moving up, down, or remaining stable is in tandem with interest rate movement. When Fed is cutting rates, our markets witness correction. When Fed is rising rates, our market witness some sort of rise. And when Fed rates are stable, we see the best rally in Indian market or Asian market. Hopefully, this year when Fed is cutting rates, we won't see much sharper correction, or will history repeat itself? At the end of the day, events will continue to shape equity market. US Fed is expected to cut rates by March 24. If they cut later, maybe we will see correction. Market today is pricing in BJP government. If there is surprise, markets will see positive reaction. If there is shock, maybe on the result day there will be correction. Market is pricing in energy prices to remain around $80 a barrel. But with geopolitical tension rising, higher energy prices could act as a speed breaker on our market. Rural recovery has remained subdued for most of the post-COVID era. Market believes rural India to recover. Any delay there could also have impact on our market. In a scenario where interest rates will fall faster than expected, oil prices remain subdued than expected, India continues to deliver on its macroeconomic, and election result gives positive surprise, market has good chances of moving further higher from current level. Events which will go against that expectation will obviously bring correction in market. Coming to equity investment opportunities, our systematic investment plan across equity funds on a rolling return basis is on 29th of December, continues to show very good numbers. The SIP per se is ranging over last 10 years across our equity funds between 15% to 23%, and alpha generated over benchmark index ranges between 2% to 8%. If we look at our hybrid funds and tech saver and sector funds like infra, the number continues to look impressive. On a 7-year basis, SIP returns are ranging between 10% to 16%, with alpha ranging from 1% to 6%. Undoubtedly, on a rolling return basis across our equity and hybrid funds over the years, we have not only delivered double-digit return, but also more return than benchmark index. If we go on a point-to-point basis, the numbers look impressive. On a 10-year basis across equity fund, on a point-to-point basis over last 10 years from 29 December 23, equity funds return range from 16% to 24%, and alpha ranges from 2% to 7%. Of course, there are periods where some of the funds have not delivered positive alpha or outperformance over benchmark index in last 3 years, 5 years, 7 years. But hopefully this trend will reverse in the days to come. Across our hybrid and other equity funds, again, alpha generation story continues. When we look at SIP, the SIP returns are also ranging between 16% to 23% over last 10 years. And across most of the time periods, our SIPs have delivered better return than benchmark index. In hybrid funds and other funds, the same story continues. Double-digit SIP return with low single-digit alpha generation. If we look at Kotak Flexi Cap Fund, which is our largest equity fund, it had a slightly off period where it failed to outperform benchmark indices. But despite size, in last couple of years, it has started generating more return than benchmark indices. Kotak Multi-Cap Fund, since its launch 2 years back, has done exceptionally well and generated mid-single digit alpha in that short period of performance. It allocates between large, mid, and small on a top-down as well as bottom-up basis. And this fund should be part of your recommended portfolio. Kotak Equity Opportunities, which is blend of large and mid cap, also has done exceptionally well, and it has generated return ranging from 18% since inceptions to 31% in last 1 year. And it has generated mid single digit, high single digit, mid double, the mid single digit kind of alpha. EQ Contra again is one fund which has consistently delivered better return than benchmark indices. All these products, flexi cap, multi cap, EQ Contra, equity opportunities, I'll recommend you to have a look at portfolio, and we remain confident about their performance. Coming to fixed income market, US inflation has started easing off. Market expects Feds to start cutting rates from March 2024, and they expect US Fed to cut rates by about 75 basis points in this year. In India's context, inflation is well within RBI's comfort level. Fiscal deficit, though it remains elevated, it still remains within comfort level of government. The systematic liquidity started turning negative thanks to FX outflows in between. RBI has managed this systematic liquidity quite nicely, and which is where the impact on 10-year yield, despite negative liquidity, is negligible. We believe RBI will maintain adequate liquidity, and hence interest rates will remain in a range-bound fashion with a downward bias. Since systematic liquidity became negative for a while, there was little bit of pressure on the short-term rates, and which is why you have now seen our short-term funds like money market, low duration, delivering very good return. We believe this is time to build long maturity. This is time to go as long as possible in duration. After Fed cut rates, RBI will probably follow them, and the big figure of Indian 10-year gilt, which is right now 7%, should become somewhere around 6% handle towards the end of current year. We believe interest rates in India will decline, especially from middle of the year to end of the year, and hence it is time to go and buy longest maturity or longest duration possible. The 10-year yields journey, while on the downward side, will continue to have its share of volatility. Vote on account is unlikely to guide market, but if there are more freebies announcement, there could be some hardening of yield. General election results, contrary to market expectation, will push yields higher, and the jugalbandi of RBI and US on cutting rates will have long-lasting effect on our bond market. On the debt side, if you want to look at investment, Kotak Dynamic Bond Fund provides an excellent opportunity. It has delivered more return than benchmark indices, and on a 5-year daily rolling base basis, the scheme has generated fantastic performance. Our hybrid fund continues to provide good opportunity to conservative investors. If you look at Kotak Equity Savings Scheme, we put about 10 to 50% in equity, cash equity, naked equity, and we put remaining money in arbitrage position to go to 65% allocation in equity in order to get equity fund status. In last 9 years, average equity allocation on the naked basis, cash basis, is about 29%, somewhere halfway of 10 and 50. With 29% allocation to equity when markets are rising, we give 41% participation. If market goes up by 100, we'll deliver 41%. We have delivered 41% participation in last 9 years. On the other hand, when market goes down, against 29% allocation, I deliver 13% participation. The upside downside ratio of 41 divided by 3 is about 3 times. The current equity in equity savings scheme is about 34%, which shows our positive outlook on equity. If market continues to rise, this number can go towards 10%. If market continues to fall and becomes attractive, this can go to 50%. Buying more when markets are cheaper, selling equity when markets are expensive, we deliver better upside downside ratio, which is so necessary for a conservative investor. Do look at our area of hybrid funds, from Kotak Debt Hybrid to Kotak Equity Savings to Kotak Multi-Asset Allocator Fund of Fund to Kotak Balance Advantage Fund for a better upside downside ratio. These are the products which will be suitable for public at large, conservative investors at large, retirees at large, and I'm sure this will work well for your investors. Kotak Debt Hybrid Fund has about 25% allocation to equity, and it has delivered double-digit returns since inceptions across last 1, 3, 5, 7, and 10 years. And it has generated very good alpha. Someone who wants less volatile return, less risky return, this fund is appropriately suitable. Unfortunately, there will be no tax advantage available in this fund. For tax advantage, Kotak Equity Savings Scheme will be more appropriate. It has delivered high single-digit return over last 1, 2, 3, 4, 5 years. In most of the time, it has delivered positive return. And in most of the time, it has also delivered more than 7% return. In the long term, on a 3-year basis, there has been no instance of negative rolling return. Again, this is the fund to suggest to retirees, conservative investors who want to generate little less volatile return. On gold, since COVID time, we have been bullish. In 2020, 22, and so far in 23, we have been proven correct. Only in 2021, gold delivered negative return, which we had not anticipated. The reason why we remain bullish gold is one, it's one asset which is attracting investors' attention. Last year, gold was up 13% when most commodities were on the negative side. This was primarily driven by the central bank buying. Now, central banks around the world are buying almost 1,000 tons of gold, creating pressure on gold prices as demand has started outstripping supply. Gold also benefits when US interest rates correct. In the 93-94 cycle, gold went up when US interest rates had corrected. The same thing repeated in 2001 post TMT bubble, and gold had one of the best historic run. In subprime crisis, the same thing happened and gold had a bounce back. The same thing happened in 2017-18. when interest rates came and gold delivered a very good return. Now we expect US interest rates to come down. Will that mean that gold prices can go further higher? We believe between central bank buying and US interest rates being cut, there is a reasonably good opportunity for gold prices to cross from $2,000 handle to $3,000 handle over a period of time. Silver is continuing to mimic gold. Demand has remained on the higher side and supply has remained under control. This bodes well for silver commodity, just like the gold.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.